The following script was written, verified, and approved by compliance professionals. A portfolio represents the complete collection of financial assets owned by an individual or institution, serving as the central organizing unit of investment management. Statutorily, the Investment Advisors Act of 1940 and FINRA Rule 2111 define the portfolio as the unit for assessing suitability. This regulatory evolution shifted the focus from isolated transactions to the investor's total exposure, ensuring that every security aligns with specific financial objectives. Every asset, from equities to fixed income, must be managed within established risk parameters to meet long-term investment goals effectively. Modern portfolio theory dictates structural mechanics, where asset allocation serves as the primary determinant of long-term return and volatility. Financial regulations require professionals to evaluate portfolios based on specific data points, risk tolerance, time horizon, and liquidity needs. Key thresholds include the 60-40 equity-to-bond benchmark, though actual allocation must be monitored against idiosyncratic and market risk triggers. Thresholds are also defined by market capitalization categories and sector concentration limits that guide prudent portfolio construction. Professionals must identify when an allocation drifts beyond specified percentage thresholds, which can expose the investor to unintended risk levels. This triggers mandatory rebalancing to restore the intended risk profile and satisfy the customer-specific suitability requirements mandated by federal and self-regulatory frameworks. Operational requirements for portfolio management involve clear disclosure delivery mechanics and dual-channel mandates for transparency. Under the Investment Advisors Act, registered investment advisors must fulfill a fiduciary duty, which includes a duty of care and a duty of loyalty. This requires full disclosure of all material facts and conflicts of interest through the standardized Form ADV filing process. Physically, portfolios must be managed to meet liquidity boundaries, ensuring assets can be converted to cash without material price impact. This ensures the investor can meet specific customer obligations, whether near-term expenses or long-term income needs, without disturbing the portfolio's core. Disclosure of management practices and fee structures is not optional. It is a foundational requirement for maintaining discretionary authority over client assets. These standards ensure that the operational handling of the portfolio meets current regulatory expectations and legal obligations at all times. Supervisory controls require the integration of portfolio strategies into a firm's written supervisory procedures, commonly referred to as WSPs. Jurisdictional oversight by the SEC and FINRA ensures that books and records retention cycles are strictly maintained for all portfolio recommendations. These controls are designed to prevent churning or excessive trading by enforcing the quantitative suitability standard across a series of transactions. Regulators have the right to access these records to verify that a series of transactions, when viewed collectively, is not unsuitable for the investor. This oversight extends to the verification of independent research and the due diligence processes that underpin reasonable basis suitability for any recommended strategy. A well-constructed portfolio balances risk tolerance, time horizon, and objectives through disciplined asset allocation and diversification. Rebalancing ensures this profile remains stable over time, while strict adherence to FINRA Rule 2111 and the fiduciary standard protects the investor. Knowledge gets you qualified. Visibility gets you hired. Explore financialregulationcourses.com for professional memberships that combine verified profiles and QR code resumes. Access intelligent career tools designed to help ambitious finance professionals stand out long before the interview begins. Visit us today to advance your career.